We are starting our last part of the summit today. This is about scaling real-world application. If you really want to scale, you also need to get sufficient fuel, meaning sufficient financial money to scale your activities. And this is also why I would like to welcome Massimo Portincaso, chairman of Hello Tomorrow, but also active on more fronts, to give us some insights on investing into deep tech startups that are working in the field of electrocatalysis. So Massimo, feel free to share your presentation, and I'm very curious to hear more what you want to tell us today.
Wonderful. Can you see the presentation?
It's coming up. Yeah, so I think if you move. Yes.
Okay, perfect. So thank you, Eike, for the introduction. And I'm really looking forward to going with you through a little bit more than investing in deep tech. I will call it today being invested in deep tech. So this is a little bit the focus, less from the venture capital point of view, but what do you need to look into investor coming and working with you to be successful in this space, and what are the shortcomings and what are the things that you need to consider. And there's been a lot of turmoil. Just in this week, Economist, there is a long article about how the venture capital model and investment world is being changed over the last few years. But before we go into really the investing, I think it's really important to set the scene and understand where are we in the overall process and where are we in the history of investing. And what is really important to understand that we are now entering a new wave of innovation that also require a different funding model. And if we go back to the beginning of all of this was in the first and the second industrial revolution. This is when the foundation of our economic and industrial tissue was set. And things like industrial combustion engine and energy and electricity, but also chemistry took place. This led to a lot of big companies, some of which are still operating today. And this wave of innovation lasted till the Second World War. But then between the 50s and the 80s, there was a second wave of major innovation, which was a wave of innovation that was basically funded from the state and the big corporate labs that were collaborating. And it was the IBM Research Center, it was the Bell Labs, it was Xerox PARC, was the NASA, and this is the wave that literally gave us the computer and brought us to the moon, but the funding came mostly from the state and also from this big corporate. And the next wave, which is the one in which we were till not long ago, and it's still there today, but it's starting to go down, is this third wave. It started at the end of the 80s, and this is the model of reference that we have in mind in terms of investing and also being invested. And this is the wave that came, and if the previous wave gave us the personal computer, this is the wave of the digitalization ultimately. This is the wave that gave us Google, Apple, but also Facebook, Microsoft, and Airbnb, and at the same time, Genentech. And it's not by chance that you see here one of the big household names in investing, which is Sequoia, that funded many of these big companies. So the funding model in this way was about digitalization, it was about computation, and it was funded through venture capital ultimately. But this wave is starting to ebb a little bit, and there is a new wave that is coming, and we're starting to see the pandemic has accelerated dramatically. It was already building before the pandemic, and this new wave is a wave of innovation that is focusing on the combination of bits and atoms. And ultimately, what you're doing with electrocatalysis, working on materials, is the perfect summary of what is happening now. It's a new wave of innovation. You are leveraging a lot of the computation, a lot of the digital side that was happening in the previous ways, but you are going to the physical world. And this requires a completely different investment model. It's not just about scaling software. It's not about the next biotech. It's something completely different. And if the companies are ahead of this and are really driving this innovation, it has to be said that the financing of this wave has not caught up yet with what needs to happen. And we see a lot of disruption. Why it is different? Why this new wave requires a different approach is way more complex what is happening here. This is at the root of this. And what is basically happening here is that this new approach in this wave that it's what we call deep tech, which is an approach toward innovation, is dramatically expanding the option space. The barrier to innovation are diminishing. And as you're doing here, there is a combination, a convergence of approaches. You have a problem orientation, so the design, you have the science of the chemistry, and you have the engineering to bring those two things together. And at the same time, you have a convergence of technologies. So you have matter, the chemistry. On the one side, you have computation and cognition, and then you have sensing and actuation at the same time. In some of the previous talks, somebody spoke about microfluidics and what is happening there. And these are all things about the sensing and the actuation that is happening. And the combination of those two things expands dramatically the option space. So when you come to this, it's not that you're going to have a next business model where you can understand what is happening. Investing in this space is very difficult because everything is very new. It's fundamentally radically new. It is not so easy to understand what people are doing and really understand, is the science ripe? Is there system science risk? Is the technology going to work on the one side? So this is one dimension. And what is happening is that this complexity, this expansion of the option space is calibrated or compensated by the problem orientation. And this is also that some investors are starting to do. They're focusing on the problem and they're building their expertise to see, okay, let's build expertise around this problem, and then we limit the option space and we can start seeing who is coming up with innovative solution. But this is not the only thing that makes this more complex. What is happening on top of this is that the time at which new solutions are going to be produced is dramatically collapsing. So we have an expanding option space. At the same time, the time to get to the solution is dramatically compressing. And I've been discussing this with Eike several times. You know, the traditional time to come up with a new material is 20 years. You will find in the literature multiple places where this is quoted as the reference. But what is happening today is something different. And what is happening is that these 20 years are getting closer and closer to 2 years. And maybe one day are going to get to 2 months. We don't know yet, but definitely it's not going to stay at 20 years. So the time is collapsing and the rate of innovation is getting faster and faster. So it's very difficult for me as an investor to really master this, where I have an expanded option space, the time is getting faster. So how can I do it? It's very, very difficult. And you really completely change the paradigm, because what is happening in this wave of innovation and what you are ultimately trying to do is not just to say, okay, let's come up with a new business model and then we're going to code something and we're going to launch a new software as a service piece, done, easy. What is happening here is something more profound. And what is happening is that the innovation that is happening here is happening along 4 different lines. And it starts with the idea of, could reality be different, and can we make it possible? Those are very different questions than asking, okay, is there a new business model available, or is there a new target, a new molecule that we can use and bring to market in terms of product? So this is making the investing more difficult. And even if it weren't enough, what is happening on top is that because of this complexity, operating in a deep tech environment, you cannot do it as a lone cowboy going through it and really doing this. You really need to work within the ecosystem. You need to leverage the ecosystem. You need to participate in the ecosystem, not only as a startup, but also as an investor. You really need to master this. And this is an additional level of complexity that comes into the investing process. This is the theory. In practice, what we're seeing is that the amount of investment going into deep tech is dramatically increasing. It's really going up. And in the research that we did with Hello Tomorrow and BCG, we said that if people are going to master it properly, it's going to probably triple over the next 5 to 6 years. And we're seeing the first sign of this skyrocketing because of multiple economical and macroeconomical factors. So you will say things are going up, there is more money available for startups, so we should be happy. And it's not only that, what we're seeing is that really the amount of investment, of private investment going up. And if you look, advanced material is the one going up the fastest in all of these. So the amount of investment is going up. The medium amount per investment is going up. So you would say everything is perfect. why do we need to talk about investing in deep tech? And the truth is that the situation is not as good as it looks. And the truth is that ultimately the way investing is done today is not fit for purpose for what is needed to really accelerate the change that is needed and to really to leverage and capitalize in the powerful innovation that can come through deep tech and that you are driving ultimately. And why it is the case? It's not that there is one culprit, there is one entity which is responsible. It's systemic. It's just really all the actors in the system are encountering or creating frictions in all of these. And it starts, of course, if you look at the core of it, is private equity and VC funds. We're going to see why, but their model is really rooted in this third wave and has not yet adapted to this fourth wave that we've been talking about. They're still in this blueprint that was created for that wave and has not adapted there. But the same is true is that the government and the institution haven't yet understood how to do it, don't have the mindset which is necessary to do it. Corporates are still not equipped. They were not equipped even in the third wave. So forget about in this wave to be able to go with it. And what is really important, and when we started this analysis, we really underestimated it, but the limited partner, the investor, are the ones that are struggling the most because they are far remote from these. The level of complexity that you have with the science here is at times sobering for people. You know, if I come to you and I say we should invest in nuclear fusion and should we go with magnetic confinement of laser confinement, 99.999% of the people in the world will absolutely have no idea whether one or the other is better. So this makes for limited partner very difficult. And if limited partner have a difficulty, then it's more difficult for the funds to attract the money. And then if the funds are not with the VC or the PE funds, then it's difficult for the ventures to get it. So it's a complex conundrum that has come together that needs to be unlocked. We are starting to see the first signs of this conundrum being tear apart and recreated, but it's not that it has been solved already. And as we were saying, the venture capital model as it is today is not good today, and we're going to see some of these down the line. And ultimately, this is the interesting thing. You see, there is this meta paradox where we see there is a new wave coming, there is a lot of money in the market. Ultimately, deep tech investing is rising, but yet we have a problematic. It's not so easy to raise money. Why it is the case? Ultimately, there are four paradoxes that exemplify and nail it a little bit. What are the problems? The first paradox is about the mindset. It's ironic almost that the origins of venture capital in this third wave were exactly the one that deep tech matches today. It was about really science breakthrough. It was about long-term vision. It was about problem. That was the wave that gave us the semiconductor. This is where the venture capital world is coming from. But the venture capital world has shifted away from this vision of really changing the world, and they really started focusing more and more on very established blueprint. On the one side, the blueprint for ICT, so computer, where you have high market risk but low technology risk. You're going to code it somehow together. And this is a risk profile, or you have the other risk profile, which is the one about biotech, where you have high technology risk on the other side, but low market risk, because if you have the molecule, you have a market. And these were the two kind of blueprint that the VC world in the third wave mastered, and they knew how to deal with it. And therefore, they moved away because they came into this blueprint and moved away from the real origin of it. And we have the irony that deep tech is very close to the origin of VC, but VC today is very far from it. The second paradox is, and this is one of the paradoxes that I love the most, which is that if you talk to LPs, but also to some venture capital, this is changing a little bit over the last year. But when we did the research 1 year ago, it was still the case that people say, no, I don't invest in deep tech. It's too risky for me, because they didn't know how to deal with that risk. And ultimately, the paradox is that it's way more riskier not to invest in deep tech, because what is going to happen through deep tech and the work that you are doing is going to completely change the world. And if you have not invested there, you're going to really be at risk with what you're doing. The last paradox is that while the barriers to innovation are getting lower and lower, it's getting more and more difficult for new funds to raise. So you get an over allocation of capital to established funds. But if you have new specialized funds that are trying to go into deep tech, maybe have the expertise to do it, is very difficult for them to access the capital. So if you look at the number, while the average size of the fund has increased over the last year, the median has gone down. It means that you have a few super big fund, and then all the other one are getting smaller. And this is a problem because you need a certain size to be able to invest in deep tech, as we're going to see. And the last and the most important paradox is that there's never been so much money in the market. There is more than 2 trillion by now on dry powder, so capital that can be allocated. And on the other side, deep tech ventures are struggling to get it. So why it is the case? And I think there are basically 3 myths that are coming here. There are many things that are coming together for why this is the case. But I really love this quote by Dekin Sloss, who is the founder and the general partners of Prime Movers Lab, which is a VC that has really understood how to do investment in deep tech. And he said there are 3 big myths. It's just that it takes longer, it's more capital intensive, and it's higher risk. And he says this is absolutely not true. And what we are seeing out of the research, it is absolutely the case. And this is really important for you as you go through these and you articulate these in your pitches, in talking, that you can really talk to people and explain what is happening. And I think this is a very important part, because as Eike has mentioned, I'm also acting as investor, I'm working with startups. And one of the things that I've seen very often is the lack of capability of the startups to articulate a very compelling narrative. And really, you are ultimately a bunch of very, very, very capable scientists. And what I've learned is that scientists are very conservative and tend not to really articulate the positive, while in city, many software startups will claim things that are not there. I've seen so many scientists saying, oh, this is not proven 110%. I cannot put it on the slide. It's only 99.9% true, what we have done. And it's really important to not only to change the overall narrative, but also for the startups, for you, to be able to speak the language and articulate what you've been doing in a way that is compelling, and also to preempt some of the myths about the fact that it takes longer, or it's more capital intensive, or that it's higher risk. So let's go concretely a little bit more how this happened. This is a little bit what I was mentioning before, where you say you have these 2 blueprints, where one, which is ICT, where you have high market risk and low technology risk. And you have the other one where you are high technology risk and low market risk with biotech. But the point is that deep tech is perceived to be high risk and high technology and market risk. And ultimately, this is not true, because there are ways by which startups are really lowering the risk first. And this is really important. I assume, and I would assume, that you don't have any science risk left. If there is still science risk in your venture, you should go back to university. What happens with deep tech is all about the technology risk, and technology risk can be mitigated, can be really addressed, and you can work through design, build, test, learn cycle to reduce it, and this needs to be articulated. So look for an investor that has understood that is going to help with you. So this is an important part. So the risks are overestimated, but you need to convey to people what are the real risks that you have and how you're going to address and mitigate the engineering risk. This is really important, but not start say, okay, we have this science thing and we might want to prove if it works. That belongs in university. 99% of the investor will not invest in there. The other big myth that we have, oh, I have an overlap in the slide. Okay, now it's working. The other big myth is that, oh, deep tech requires more money. And I've heard it many times. And what people are forgetting in doing so is, one, that there is much higher availability of shared infrastructure. So some of the stuff that require more money doesn't need that much money today. But what we have seen is ultimately it is the opposite. What happens, it's true. In the beginning, deep tech startups require a little bit more money, not dramatically that much more, but in the longer term, actually they require less money because they can go and utilize other sources of financing, while the pure digital need to continue invest to gain market share and buy the market if you want. With deep tech, you can come to revenues and you can use these, and you can use different tools to be able to do this. And this is one of the things that it's really important to convey. Say, yeah, at the beginning, maybe it's a little bit more, but it's also where most of the value is created, the beginning of the investment. Down the line, actually, deep tech require less dilutive capital down the line. And there are different tools to be able to do this. You can really optimize and do more with less using DBTL cycles and also using shared infrastructure, being problem oriented. And on the other side, you can really resort to non-dilutive funding when first commercial revenue. So maybe you need money to do the first plant to produce stuff, but the second and the third, you can do project financing to do this. This is going to be non-dilutive capital and things that you can pay out of your cash flow. So really important to keep in mind. And the last one is that it's too risky. And this is even an old one. The valuation of Ginkgo has gone from 4.2 in 2019 to 17 billion when they did the SPAC. And I think they're now at 21 billion. So you can really make money with it. People are starting to understand. And this is why we're seeing a bit of a race to invest in deep tech. But the problem is that a race to invest in deep tech by people that don't understand deep tech. And if you don't choose the right investor, this is going to could become very dangerous for you, because you really need people to understand what you're doing to give you the right advice. And you don't need somebody to come on board just with the goal to bring you to an exit in 7 years, cost it what it cost. You really need a partner in doing so. This is, if it was important in normal venture capital, in deep tech is even more important to be able to really find the right investor for what you're doing. And we're starting seeing that also sovereign wealth funds are investing there. There are deep tech startups buying deep tech startups and exits that have already happened down the line. So the myth that it's too risky and it requires too long time before you can, it's not true. Those things are happening. And what people forget when they think about the exit time is that most of you have probably started and spent 3 to 5 years in university working on what you're doing. And then you need to start, you don't start from zero, you start from -5. So the moment you have the company up and running for 5 years, you have a total time of 10 years. And this recalibrates about the time that is needed to get to a liquidity event. So this is a very important point. You need to look for investors that are problem focused. They are not only reward focused, that they really work with you in terms of risk mitigation and solve the problem and really help you to go through this. And to finish, really, okay, how does the investing of the future to be able to enable deep tech look like? And there are 3 very important things that we're saying investors should be doing and that we're starting seeing. There are some funds out there that are doing all of those 3 things. The first one is really having an active approach. It's really about helping you to do stuff and activate an ecosystem. And you have probably read in the paper about Tiger Global that is coming in, and they have hands-off approach, and then write big check, give you the higher valuation, go away, are not on the board, and stay away. And if you are in a software as a service environment, in a tech environment, this might make sense. For a deep tech environment, I would strongly advise against it. You really need somebody, a thought partner that can help you to scale, that can help you to grow from being a scientist to become a business builder. It's really important. And you need somebody that is not a lone wolf out there, but you need somebody who is embedded in the ecosystem, that can make the connection, can help you to push your company forward and really open doors that otherwise you would. It's not only that you wouldn't open, but you wouldn't even be aware that they exist. And I think this is really important, that really help you have this problem orientation and can help you to grow. And you know, if you're doing deep tech right, ultimately you have produced something which is so so better, the product you're creating, that you are going to have a market. The challenge is usually on the engineering side, is not on the product market fit. And I think it's really important for you for find this. The second thing that is really important in all of this is it's not only about the one model, it's the classical investment fund that is coming with 10 years plus 2 years or 1 year and 1 year's extension and the classical fees. But there are many different new investment models that are coming together that might be much better suited for what you're trying to do. So this is another part. And the last part is that, and we're starting seeing this, there was an article in Fast Company the other week talking about how venture capital and investing is going to enable what we need, particularly after having seen what came out of COP26. It's even more important that this kind of innovation is coming. Breakthrough Energy Ventures started this, but you have others that are really driving this. And you need to articulate the impact that the work that you're doing is going to have. And we have the possibility and the necessity of redoing much of society and much of the industrial economical tissue. So you can play an important role. You need to claim that and work with people that are looking to do the same. So concretely, what does it mean? As I said, you need people with in-house expertise that can really help you, be it on the technical side, but chances are that you have probably more expertise in that field, but it's somebody you can really relate and talk to. And on the other side, you need to have this ecosystem. They need to have this ecosystem to be able to help you in growing. And here there are a few quotes that I really like. Is they need to think in terms of inevitables. That's what Steve Jurstone has done, or they really need to invest in problems, as Arvind Gupta, who is now at Manfield, has done. And also, if you look at what Kozla and Fenton from Benchmark has said, you know, Fenton says, our job is not to see the future, is to see the present very clearly. And you need to show them the present. It's not about the future. And this is just to show you that the ecosystem is already there. This is analysis of the deal where they had co-investment. So if you find the right investor at the beginning, it's going to be much easier for you to go into the subsequent round because they are creating a network, and then you can have multiple support and profit from this ecosystem of the few. It seems like there are a lot of people out there, but you need to consider that there are more than 2,000 venture capital firms. So this is probably 0.5% of the venture capital firms. So it looks like a lot, but it's not a lot, what you're seeing here. And this is about the different instruments for funding. There are rolling funds, there are SPAC. I personally am not so positive about SPAC, but there are also publicly quoted funds. So there are multiple alternatives to build new vehicles to do it. And there is also the possibility, and more and more over, if I look at when we started this, which was in end of 2020, compared with today, I don't know how many funds have been raised claiming that they're going to just contribute to fight climate change or to contribute to sustainability. So this has changed massively over the last year, and I think you have an opportunity to find the right partner among those. So concretely, and with this, I will close and open for discussion. Concretely, what are the new target archetypes that are coming out of this new wave of investment that you need to look for? You need to look for specialized deep tech private equity and VC. We're seeing more and more private equity that is moving up the value chain, investing earlier and earlier, and venture capital that is going later and later. But they have a specific focus on deep tech. And at times they offer multiple things. So if you look at what EQT is doing, they have a venture capital part, but they also have a growth fund, and they even go down to evergreen and all things forever. So they have the whole capital stack. The idea of adaptive capital, the fact that it's not that you have one Series A, Series B, Series C, but you really need to think in terms of project financing, because if you are in deep tech, chances are very likely that you have also some hardware. You need to buy a plant, build a plant, or build facilities. And you need to see where do you bring money in, which is dilutive, and where you can bring project financing, or you can do revenue sharing. There are different ways of looking at it, and look for investors that think this way and don't just have, okay, I do Series A and B, and that's it. I think it's really important. The other part is that what we're seeing is that there is more and more an understanding that in this space, the value is created upstreams and not downstream. It's just really making and building the right company. If you look at what Flagship has done with Moderna and with many other companies, Moderna is not a company that was founded and then funded by a VC, but the company was founded by a VC. So this venture building capital, and Flagship is still the biggest shareholder of Moderna today, more than 10 years after. So this idea of venture building is very important in this new environment. And then you need to look, very important, look also for deep tech savvy corporates, but they need to understand this game. You need to have somebody who's going to come in, but is not completely lead it, because it's going to decrease the attractiveness of the round for you if you have a company. So if you have a round for 10 million, then you should bring a company with a 2 million ticket, not bring them with 8 million, because nobody else will want to invest. If you have this, then it's a M&A that you're doing, is not a venture round that you're doing. So it's really important, find the right corporates. They're really important to allow you to say it's a validation of the market that you have. It's a possibility to really test, go to market and scale, but you need to do it in the right way. And government and institution, they also change a lot during the last year. So there is a lot of more understanding of what is needed, and a lot of Horizon funds or funds from the EU that are supporting some of these. So if we summarize this visually, this is the old world that we had on the left side. It's a few small deep tech VC. And then you have corporate investor and pension and sovereign wealth funds doing a little bit in the early phase, a little bit more down, and the government doing it. And what we need is the picture on the right side. It's something that is covering the whole spectrum, with at the bottom, deep tech ventures building on top of which you have deep tech adaptive capital that goes up to really Series C and even IPO. You have deep tech VC, you have deep tech private equity on top, and then you have corporate investor, pension and sovereign wealth fund, and government going all the way down. And this is the landscape that I hope it's going to materialize very soon. And I think that there are some good actors that are working there that have already understood this and try to find them and select them, because one of the important things that is coming out of this craze to invest in the availability of capital is that luckily many of you can end up in a position in which they can choose, or you have way more negotiation power that you could have had a year ago. So use it wisely to find the right partner that are going to help you in the long term. Don't think about just signing and going with the one that is offering the highest evaluation. Think about the longer term and who are the best partner for you to grow into this new world. So what should we look for? Ideally, you should look for a fund that has a certain size, 150 to 300 million, because you want them to stay with you from seed or pre-seed to Series A and Series B, usually, so that they really go the journey with you, that they have some strong investor, so a sovereign wealth fund or some family office behind, somebody that has a very cross-cultural piece, that understand the science, but also understand the engineering side of things, and have a very diverse setup. They have a strong ecosystem. I cannot stress this enough. That they really think in terms of thought leadership, I'm a former BCG partner, but I can tell you that right now, the best content that I'm reading is not coming from consulting, it's coming from venture capital. So try to look at the one that are really thinking ahead and really can help you in this journey. And really are looking to make the world a better place, and ideally that they have a longer time span to do it. So that's what you should look like in the investment world. That was it from my side.
Thanks, Massimo, for this elaborate insights and how did you see world needs to change and to adapt to accelerate the processes. What is your view on more governmental policies in this direction? Because in some of your slides, you also see that governments and more European investment agencies need to take action. Are they shifting quickly enough, or are they still too slow in the process, or don't have the right mixture of, I would say, fund managers internally, or what is your view on that?
I can speak, okay, I can speak for what I know is Europe, the US, and I would say some countries in Asia. I think definitely there is a much better understanding. If you look at now as it was 2 years ago, they really understand that they need to up their game. There is a political will to support the startups, and there is a lot of effort in doing so. Do they always do it with the speed and let's say what is needed to do that? Not always, but the will is there for sure. It's at times is really structurally very difficult for entities like the European Union to go at the speed of a startup, and that's a little bit the limiting factor there, but definitely there is a will. And the same is true for the US. If you see what has come out of the Build Back Better, Build Back Better, yes, and the money that is going to these new institutes and so on, there is, or what Singapore is doing, it's fairly amazing. There are a lot of opportunities there for sure. It's way better as it was just a few years ago. Is it perfect? Not yet.
Will it ever be perfect?
No.
Any questions from the audience? Please raise your hand or just unmute yourself. From your point of view, Massimo, do you see more happening in the field that we are discussing today, electrocatalysis, so green hydrogen, CO2 reduction, or ammonia reduction, and what is your view on that progress?
I showed the numbers that are going up. I think that a lot of eyes are right now on other stuff. I think this is the field with the highest potential. You and I spoke about it. I think that materials is really the place where a lot needs to happen, where the potential is to happen. I would compare basically this point in time in the material side where synthetic biology was 10 years ago. That's the same. This is now when you need to do the investment. In 5 years' time, everybody will talk about it, but it will be too late because the great company would already been founded. So I think this is the area where I look with most interest. That's also why I'm always very keen to participate on the Materials Pioneers Forum, because I think that this is the area really with the not only the biggest potential, but the biggest urgency, because we need to really change fundamentally the way we deal with materials. And I'm a big fan of the work that you are doing with VSP, but also with Materials Pioneer.
I don't know if you, thanks, of course, I don't know if you have been able to watch the talk of Charlotte talk this morning. If not, you should definitely watch it or watch the recordings. Oh no, this one will not be published. But she showed quite clearly that 35% of global GDP, so all the value that is created in the economy, is directly impacted by heterogeneous or by catalysts. And then 80% of those catalysts are heterogeneous catalysts, which are currently driven by high temperatures and high pressures. And most of them will be switching over to electrocatalysis. So it's a very, very big part of the economy. It's a part that, if you're in the field, it's quite logic. If you don't have any here, you don't know anything about catalysts, it's a very unknown field, and we don't know how big it is. But it's also the area where, yeah, we need the most accelerated development to really make all the deadlines a reality. And that's also why we are, from the particle point of view, very happy today that we were able to show the first results on our PEM water electrolysis membranes, where this should be a drastic simplification of the production process and still perform a much better membrane.
No, absolutely. It's just that's also what I meant, that people are not seeing yet, because that's exactly the reason what you say. If you take out thermocatalysis and heterogeneous catalysis out of the equation, all of these, it's not that it's going to go away, it needs to shift. And it's going to shift to electrocatalysis in a vast majority of the cases. In some other cases, we completely replaced by something completely different. But some of it, at the vast majority, will move over. And that's why I'm so keen about this field, because I think this is where a lot of potential is there.
But I'm also curious to understand, because I'm speaking to many investors, but there are not so many that know or have sufficient knowledge about catalysis, let alone electrocatalysis. So I think it is also a big struggle for most investors that normally are used to evaluate, let's say, financial statements or Excels, and now need to mentally understand the problem and the potential of certain deep technologies. Is that also a big struggle that you see they are facing?
Yeah, and this is a super point that you're making, because this is a little bit of a dog that is, I don't know, it's just a vicious circle, so to say, because the point is that there are a few big funds. And if you look at Breakthrough Energy Ventures, I think 50% of the team is PhDs. I think they employ 50 PhDs that really understand what you're talking about. But then all the other, they are much smaller. They cannot afford to have a PhD on their bench to do it. A few may be talking to professor or whatever. And this is really the problem. That's exactly what I was mentioning. There is a lot of capital, but very few people that really know what to do properly. That's what I meant, my example, not to go with material and catalysis, but to say, okay, I come to you and say, shall I invest in magnetic confinement for nuclear fusion or laser confinement? 99% will not know, and will not even know what to start and what does it mean. Why do I need to confine the magma, the plasma when I have nuclear fusion? So this is really the difficulty, and that's why finding. I said choosing, but in actually what is really important is finding the right investor. That and that's what you and I had this discussion. But when I talk to startups, I really recognize almost a sense of relief. Oh, finally somebody that speaks my language and understand what I'm talking about. And it's a completely different discussion. It's not that they're trying to explain why this is important, but really finding somebody that has the same thinking and can help you to elaborate on that. That's exactly what needs to happen in this investment space, because they don't only bring the money, they need to bring also these to help you to grow.
I can completely agree with you, because normally, let's say a 30-minute, 45-minute intro call when you're speaking with a new PC, but instead of just showing a few slides on the adaptation or the customer growth over the last few months, you first need to educate them on the field that you are disrupting, which already takes, let's say, 25 minutes to give them a basic understanding, and then you are coming to the point that, okay, this is how it used to be done in this field, and this is how we are simplifying it or accelerating it. And then, yeah, after the 45 minutes, they are, let's say, their heads are stuffed with information that they need to digest. And then still they need to make a decision.
And I think this is a very important point. This goes back to the one that I did at the beginning. I have met a lot of startup where a normal investor would have passed because the team was not perfect yet, or the product was there, but they didn't explain it the right way. And I'll tell you one story. The winner of last year, I'll tell this after Martin has asked his question, given that we have one question.
Martin, feel free to ask your question.
Thanks. Yeah, I have just a quick question because I understand why investors are not willing to invest in this because all of the things you talked about, it's complicated and it's hard to bring across. But what I really don't understand, and I'm curious to hear your opinion, why are these big companies that are established companies working in the catalysis field, in the chemical industry, why aren't they not doing anything? Because yeah, that's really puzzling me because the whole hydrogen market and electrocatalysis is going to be $1 billion market. That's pretty clear. And some even say $1 trillion market. So I really don't understand why they are doing nothing.
It's the innovator's dilemma. It's just they sit on something and they're putting their head in the sand and just really trying to convince themselves that things are not going to happen. I had yesterday a very different field, a conversation with a biotech, a leading edge biotech startup, and I was asking them how they plan to deal with super complex cell therapy and so on. And they said, no, we just do the simple stuff and I don't need that stuff. And this, you can go here, and this is the problem. That's why we need you. So on the companies, I'm not surprised because it's just really, the problem is that they have become married to the solution and not go back to the problem. And then they always look at incrementally improve their solution and then don't go back to the problem trying to solve the problem. That's basically the piece. But this is innovator's dilemma pure, a la Clay Christensen.
I see.
Okay.
It's
also dynamics within the company. So PSP, we are now at 25. Still, I can gather everybody in one room and then explain why we are making a different decision than we thought we would make. But if you're working in a company which has 30,000 employees, that's almost impossible. So before you've convinced 10 others and those 10 others have convinced another 10 others and everybody is aware of this change, you are already a few years into the process. But still, I think we need those big corporates,
yes.
like the oil companies, like the big, because they can only bring in skill that other companies are difficult to bring in. So afterwards, we have a few great, I think, presentations from Diet Cycle, Zero Emission Fuels, and also the Air Company that are really making the forefront moves into this field and really applying electrocatalysis at a very substantial scale. But again, they are not having the background and the experience and the infrastructure to bring it really to mass adaptation. That's in the end still going to be done, I think, by those big chemical and oil companies. But they are always slower initially, but then when things really become, I would say, lighted or heated, then they will accelerate.
And I'll share a kind of secret of consulting, but that applies beyond consulting, that when working in consulting, you have the same team working with a great client, delivering great work, and the same team, same people working with not as a good client, delivering terrible work. And the team is exactly the same. And for you as a young startup is as important to put emphasis on the product, on the strategy, on the product roadmap, the strategy about who are you going to work with, who are going to be your customer, who is going to be your investor is as important as that other part. Having the great product, but working with the wrong people is going to bring you down. So this is really important. There are companies, as Eike was saying, that are going to bring you up, but you need to find them. So it's a really important dimension in all of this.
Also for this summit today, I've approached quite a number of big companies, but most of them are afraid to present, let's say, their current strategy, because for them, they can only lose. They can also only be, let's say, get negative response on the work that they are doing, or they should be doing more work. While the other companies that are presenting today, they are only, let's say, a big inspiration. They are a small team trying to make big steps a reality. So that's also another dynamic that I see, that big companies are still a bit shy because they are making the initial steps into these fields and they don't want to give away the information to their competitors or to their shareholders. But I'm expecting that more of these companies will also join the third and the fourth summit coming up next year. And I think we also need them because they, in the end, also need to, let's say, standardize the things that they want to apply in industrial use, which is a very important information we need from the fundamental and more the applied research to use that as an input into our research. Thanks, Massimo. Thanks for all the great discussions and all the great presentations.